Hey guys, welcome back. Some of my subscriber audience got really excited about what I had to say in my previous video when I said that I'm more positive on Chinese equities and putting my capital to work. Others cautioned me in our audience against the risks of investing in Chinese companies. And whether you are a bull or a bear, just wanted to say that I appreciate any and all comments, so let's keep having this thoughtful and healthy discussion and analysis. Here's the issue that I see. Most investors think that there will only be one winner, bulls or bears. That's not true. In fact, I think that both bulls and bears can win in this market. It's about your timing. The likely scenario with Chinese stocks is that bears might continue to embrace the fears of regulation in the near term, but that window is quickly closing and that bulls will definitely emerge as the winner in the long term. In fact, this past week, in a blink of an eye, like I mentioned in my previous video, a bottom could be forming, and the time to be aggressive was when everyone was thinking that China was going to destroy all of their businesses, which obviously sounds ridiculous. While anything, of course, can continue to happen, I took advantage of these bargain prices and scooped up Alibaba at the $160 level and Tencent around the $58, $59 level. As a reminder, these types of drawdowns are not uncommon in tech investing in general. Even brand name US tech stocks like Spotify, Zoom, and Roku experience deep corrections of 30% or more during periods of intense negativity. And just as a reminder, even Facebook is vulnerable to 30–40% declines. In today's video, I want to share with you some additional insights into how you should be interpreting the news when it comes to China, and not to fall for FUD, fear, uncertainty, and doubt spread by the media. I wish to show you how to actually interpret the news, and then I'm going to walk you through my own thought process of how I'm assessing the situation as a CFA charter holder. I'm going to be doing this by discussing my thoughts on a recent regulation on the internet sector and why I think all these developments will end up being a very good long-term positive for China. And then I'm going to lightly talk about the VIE risks. I know that is a big looming risk and dark cloud for a lot of people, and I'm going to lightly talk about it. If you're a returning subscriber, it's time to dive deep again why we need to keep our cool when there is an onslaught of negative news on China. And if you're a bear or a critic, your comments are always welcome. I'm simply asking that you keep an open mind. If you are new, welcome to my channel. My name is Larry, and I warmly welcome you to join me in my YouTube community. I believe that if you hit that subscribe and like button, my channel is going to provide an objective and balanced situation to more people who are trying to understand China and therefore have a stronger grasp of the situation. Okay, let's get started with the most recent news that just got released on Monday. On Monday, I saw that there was a Wall Street Journal headline and article on China limiting online video games to 3 hours a week for young people. And as I read through the article, what seemed at first like a very balanced view of the situation starts becoming quite biased, as the quotes that are used are cherry-picked, intending to portray the Chinese government as a ruthless force, and quotes from equity analysts that this will essentially wipe out spending from minors. Now, yes, factually speaking, this will impact gaming companies and their business models, but in my humble opinion, the language being used isn't fully objective. Now, why then, if this news is portrayed so catastrophically, did Tencent stock only fall 1.5% the day it was released, when this supposed ruling is going to be felt throughout all of China? And then interestingly enough, the next day, Tencent goes up 5%. This was an example when I believe that it is a buyable dip, and that's exactly what happened. It's because institutional investors are quite good at determining what type of fundamental development is real or not. Now, I'm an avid reader of Wall Street Journal, but as a reminder, the Wall Street Journal is a Dow Jones company, and the Dow Jones company is owned by Rupert Murdoch, who is also the owner of News Corp and several other major media companies. Now, Mr. Murdoch is a brilliant businessman, but inside the institutional investor community, they know that he historically has had a reputation for using his media influence to subtly change the opinions of viewers against China. As a result, while trying to appear as objective as possible to well-educated readers of the Wall Street Journal, the word choice skillfully introduces both sides of the argument, but with a larger degree of skepticism and negativity towards China. Now, where I know for a fact that the newest regulation being discussed out of proportion on the media outlets is after my review of Tencent's latest earnings report transcript, where I reviewed management's thoughts on regulation. Now, when in doubt, it's a very powerful practice, and not just in investing, to find the primary source of information to really understand what's going on. Now I'm going to spend some time sharing with you the key takeaways from what I found from Tencent's earnings transcript Q&A section, which will hopefully help you understand, number one, why you should always find the primary source for information, and number two, why you should read media statements with a grain of salt. So here is the Q&A section. Now, there was a very intelligent question asked from Han Jun Kim from Macquarie, which is a major investment bank. He started off by saying that there's been a lot of regulatory developments in the market, and then proceeded to ask, are there any in particular that you want to call out as things that might have been different from the way that you were envisioning in a few months or a few quarters ago, and how might that impact our strategic initiatives or priorities and so forth. And Tencent's president Martin Lau responded by saying that these regulations on the internet in China is a global trend and not just limited to China. In fact, he goes on to say that China is even a bit ahead in terms of a more structural regulation framework. He then comments on the fact that these regulations will eventually foster a long-term sustainable development of the internet industry, and that he believes that this is going to be good for them and for the entire industry over the long run. And over a longer period of time, Martin expressed his conviction that Tencent is not only positioned to be compliant, but also embracing the regulatory environment. They are stressing social responsibility and emphasizing that they want to use their technology for good. And this is significant because all of these regulations are actually legitimizing the activities of Tencent and also Alibaba, which in the past several years have been much more liberal and unregulated in terms of how they use consumer data. And once the regulations are in place, investors will understand that these new frameworks from which they can operate. And this will actually establish more trust from foreign investors to understand how Tencent can operate going forward. Now, later on in the earnings call, Gary Yu from Morgan Stanley asked a follow-up question, which was whether Tencent sees any more dramatic measures from regulators on the gaming industry, and whether there will be more limits on time for minors below 12 or for teens under 18 years old. And this next part is absolutely critical, and this here is some critical insight. Tencent responded by saying that they were already discussing with regulators on how this issue of minors spending too much money and time on games would be resolved. And they said that if they can regulate the total amount of time spent across different games, that would address the problem, and that it requires a system to police it. Tencent said that on the Q&A call. And we can see from the media outline that the ban on video games is heavily focused on the time spent on gaming throughout the week. Now, I do not work at Tencent, and I do not know anything that isn't public, but I believe that Tencent's stronger relationship with Chinese government officials allowed them to co-create these regulations together. I do believe that. And what Tencent mentioned in the earnings Q&A as a recommendation to improve the gaming time spent situation eventually turned out to be the regulation that was released earlier this week. And also, what the media did not mention and could be found only in the earnings transcript is that children under the age of 12 only accounts for 0.3% of their total revenues. In addition, under 16-year-olds accounted for only 2.6% of China's gaming grossing receipts. So I find it really interesting that these facts and financial figures were omitted from the media's outlets of the breaking announcement on the ban on gaming and how it would impact Tencent and gaming company Bilibili. In addition, Tencent's ambition for their gaming business is global, and they are aggressively repositioning their China-centric business to a truly global business, which could triple their total addressable market according to Tencent's management. In fact, Tencent is already building momentum globally as their international gaming revenue grew 37% year over year and even penetrated the Nintendo Switch opportunity and even moved into the Japanese market. So while the media outlets will portray this as a move solely by the Chinese government, I actually think that Tencent cooperated with the government and influenced this regulation. The bottom line is that from these interactions, I believe that the government is not out to destroy industries, but rather to make the Chinese society more sustainable and stronger going forward. And I believe this is why big money from institutional investors scooped up shares of Tencent, and now it's actually above its 20-day moving average, while retail investors sold because of the fear, uncertainty, and doubt. Now, I don't know what Chinese officials are precisely thinking with this latest ban on gaming, but if I had to postulate and hypothesize, here's what I think. If Chinese teens play fewer games throughout the week, they would have more time to dedicate to their studies. They would also have more time to participate in extracurriculars that would enrich their perspective of the world. Their participation in athletics could increase. Their reputation in the Olympics could strengthen. There would be fewer people wearing glasses, as nearsightedness is often caused by excessive computer usage. So this global branding for Chinese people would long-term shift towards an image of strength and legitimacy. And long-term, this is no doubt a positive for the next generation for Chinese youth. Now, as recently as mid-2020, a study conducted by Harvard's research team found that public opinion in China revealed that 95% of respondents were satisfied with the national government in Beijing. And that said, to prove that these figures were not manipulated or to include bias, they also conducted a study for the satisfaction at the local government level, which resulted in a far smaller percentage at 11% saying that they were very satisfied. Now, to provide a balanced view, the same study led by the Harvard research team found that US respondents voted that only 38% of respondents were satisfied with the federal government. So for most people hearing what I just said, I understand if you continue to have skepticism towards these facts, and I certainly respect your view. What I do believe is that these regulations will long-term end up benefiting China's increasingly prosperous society, and as a byproduct, the companies that are compliant will and can participate in the upward trends. Now, just this past week, China's largest food delivery company, Meituan, rose after its earnings report because its business model continues to serve the Chinese population well. And as the middle class grows, companies that cater to the middle class will benefit. Now, I know, some of you are probably wondering, well, all of this doesn't really matter if the VIE issue isn't taken care of, right? After all, if the Chinese companies can get delisted at a moment's notice, then all holders of the US ADR shares would get screwed over. Now, as with anything in investing, I think about situations in terms of probabilities and do my best to not let my biases influence my thinking. And I believe that the probability of delisting via VIEs being declared illegal is a rather low and even remote probability event. Now, it could happen, but it is low probability. Now, the reason and the facts and the observations that I believe that these are low probability events come from the following observations. Number one, China's Securities Regulation Commission, the acronym is CSRC, is looking to scrutinize companies that want to list abroad with the VIE structure. Well, this indirectly implies that VIEs are acceptable and continue to work. In addition, 4 government bodies, the Cyberspace Administration of China, which is the acronym CAC, the Public Security Bureau, the Ministry of Industry and IT, and the Ministry of Justice all said that a company's operations wouldn't be impacted by this regulation as long as, number 1, it complies with state laws, and number 2, it ensures that the security of critical infrastructure and personal information is safe. Third, the leader of CAC, the Cyberspace Administration of China, his name is Shen Ronghua, said that for a long period of time, we have been supporting internet companies to raise funds in accordance with laws and regulations, and they plan to continue to do so. In addition, Goldman Sachs put out in a study that 1/3 of hedge funds it had surveyed had an investment in foreign listed shares of Chinese companies in their ADRs at the end of June. And hedge funds are most well known for their fundamental research teams to really understand the legal risks of VIEs. Now, Cathie Wood, as a next point, could have chosen Hong Kong listed shares when she recently scooped up shares of JD and Pinduoduo, but she bought the American ADRs. And then finally, to reinforce my confidence that this is a low probability event, numerous F1 reports, which are annual filings that securities by foreign issuers have to make, the CEOs of these companies gave their opinion on the VIE situation. And they indicated that the chance of China finding VIEs illegal to be remote and believe that the likelihood is low. Now, as a result of my observations in this space, I do believe that VIEs, of course, are a risk, but are definitely blown up by the media far out of proportion, just like the newest gaming regulation on China and how that will devastate Tencent's business. In fact, Tencent shares are rallying 5% one day after this media event. So the media does an incredible job of generating fear and anxiety because the industry's profits depend on views and clicks. Now, I think that the greatest risk to Chinese equities is any true potential slowdown in the Chinese economy or any increased political tension between China and the US. That said, despite these rising tensions, I am very hopeful that current events such as the state of Afghanistan and climate change will force the US and China to work more closely together. Now, in a recent news piece, China's foreign minister Wang Yi was quoted as having an open mind in working with the US depending on how the US approaches this relationship. Now, the VIE risk is activated because of deteriorating relationships and is not a risk in isolation. So I think if Beijing were to do so, they risk cutting off foreign capital completely, and I do not think that it is in their best interests to do so. Now, I want to end this video by saying that most institutional investors are incredibly underweight in their portfolios in China. Institutional funds have sold China, retail investors have sold China. Sentiment now is very depressed. This might not be the precise bottom, but we're likely very close to a bottoming phase. And the combination of everyone avoiding this sector and depressed pessimism means that there aren't many long holders who are starting new positions at these levels. But let me ask you this. What happens when there is a rebound? What do you think institutional investors will do? Do you think that they are going to miss the chance to add alpha to their portfolios? Do you really think that they want to underperform their peers and lose respect? And when big money comes back in, will that rebound be slow and steady for retail to catch on? Or will it be fast and furious such that retail misses out? In fact, as of right now, Alibaba, Tencent, and Meituan, and JD, Pinduoduo are all at least 15% above their recent lows. So I'll let you think about that one. And if you want further investment research and do not have the time to do it yourself and want my balanced opinion, then definitely subscribe, turn on that bell, and like this video so that more people can see this. And I'll be building an email list for periodic investment strategy later this year, early next. Fill that out if you're interested so that I can send you some periodic updates in the future. Link is in the description below. With that said, as always, stay safe and I will see you soon.